The number is 32 million ounces. That is the total registered silver inventory in COMEX vaults as of yesterday's close. Registered means available for delivery against futures contracts. It is the metal that actually backs the promises traded on the exchange. 32 million ounces. Now consider another number. 750 million ounces. That is the current open interest in COMEX silver futures. Open interest represents the total number of outstanding contracts, promises to deliver or accept delivery of silver at specified future dates. Each contract represents 5,000 ounces. 150,000 contracts multiplied by 5,000 ounces equals 750 million ounces of promises. The ratio is 23 to 1. For every ounce of registered silver available for delivery, there are 23 ounces of promises outstanding. This is not a technical detail. This is not a footnote in a market report. This is the architecture of a system that functions only as long as almost no one asks for what they were promised. The COMEX silver market does not have a shortage problem. It has a confidence problem, and confidence problems, once they begin, do not resolve gradually. There is a standard defense offered for the COMEX inventory situation. The defense argues that futures markets are not designed for physical delivery. They are price discovery mechanisms. The vast majority of contracts are settled in cash or rolled forward before expiration. Physical delivery is the exception, not the rule. This defense is accurate in its description and misleading in its implication. Yes, most contracts settle in cash. Yes, most participants have no intention of taking delivery. Yes, the market has functioned this way for decades. But the market functions this way because participants trust that delivery is possible if requested. The moment that trust erodes, the moment participants begin to doubt whether physical delivery can actually occur, the behavior changes. And when behavior changes in a fractional system, the system breaks. This is not theoretical. This is the history of every fractional reserve arrangement that has ever existed. Banks function smoothly when depositors trust that their money is available. The moment depositors doubt, the moment they arrive simultaneously to withdraw, the bank fails. Not because the bank was insolvent in normal conditions, because the bank was solvent only as long as not everyone asked for their money at once. COMEX operates on identical logic. 23 to 1 is not a problem as long as 22 out of 23 participants settle in cash. 23 to 1 becomes a crisis when even a small percentage shift their behavior from cash settlement to physical delivery. The shift required to break the system is not 23 to 1. The shift required is far smaller, and the conditions that trigger such shifts are now present. The history of commodity exchange crises illuminates what is happening. In 1869, Jay Gould and James Fisk attempted to corner the gold market. They accumulated gold contracts while simultaneously reducing available supply through political manipulation. The corner nearly succeeded. Gold prices spiked from $135 to $162 in a matter of days. Only government intervention, the release of Treasury gold, broke the corner and collapsed the price. But notice what the episode revealed. Even in the 19th century, commodity exchanges functioned on fractional principles. The paper claims on gold exceeded the available gold. The system worked until concentrated buying exposed the gap. In 1979 and 1980, the Hunt brothers accumulated silver futures and physical silver. At their peak, they controlled an estimated 100 million ounces of silver and futures positions, representing over 150 million more. Silver rose from $6 to $50 in 18 months. The COMEX response was revealing. The exchange did not allow the market to clear. Instead, it changed the rules. Position limits were imposed retroactively. Margin requirements were raised dramatically. Trading was restricted to liquidation only. New long positions were prohibited. The Hunts were forced to liquidate. Silver crashed from $50 to below $11 within weeks. The episode demonstrated the fragility beneath the surface. When concentrated demand threatened to expose the gap between paper and physical, the exchange did not facilitate delivery. It changed the rules to prevent delivery. The precedent was established. COMEX will protect its structure even if protecting that structure requires abandoning the fiction that contracts represent deliverable metal. In 2020, the COMEX faced a different kind of stress. The pandemic disrupted logistics. Refineries closed, transportation froze. The premium for physical silver over COMEX futures spiked to unprecedented levels. For a brief period, the price on your screen and the price at your dealer diverged completely. COMEX showed $15, dealers charged $25 if they had inventory at all. The episode was attributed to logistics, a temporary disruption that would resolve when supply chains normalized. But the episode revealed something more fundamental. The paper price and the physical price are connected only as long as arbitrage is possible. When physical metal cannot move, when delivery mechanisms fail, the prices decouple. The COMEX price becomes a fiction. The physical price becomes reality. The current situation must be understood in the context of these precedents. 32 million ounces of registered inventory is not merely low. It is the lowest level in decades. In 2021, registered silver stood at 150 million ounces. That represented a coverage ratio of approximately 5 to 1 against open interest. The decline from 150 million to 32 million occurred in less than 4 years. Where did the silver go? Some was converted from registered to eligible status. Eligible silver remains in COMEX vaults, but is not available for delivery. The owner has not made it available to satisfy futures contracts. Some was physically withdrawn from vaults entirely. Industrial users, investors, and institutions took delivery and removed the metal from the COMEX system. The pattern of withdrawal accelerated in 2023 and 2024. Each month, registered inventory declined. Each month, the coverage ratio worsened. The 23-to-1 ratio is not static. It is the result of a trend, a persistent movement of physical metal out of the deliverable pool while paper claims remained stable or increased. Trends do not continue forever, but they continue until something stops them. And the trend of inventory depletion has not stopped. It has accelerated. The mechanics of a potential COMEX failure deserve examination. COMEX operates on a delivery mechanism that functions through warehouse receipts. When a contract stands for delivery, the long position receives a warrant, a claim on specific bars held in specific vaults. The warrant holder can then take possession of the metal or hold the warrant as proof of ownership. The system works smoothly when warrants are rarely exercised. Metal sits in vaults. Warrants change hands. The physical bars rarely move. But the system contains an assumption that the metal represented by the warrants actually exists and is actually available. At 32 million ounces of registered inventory and 750 million ounces of open interest, that assumption is tested every delivery month. Each delivery month, some percentage of contracts stand for delivery. Historically, this percentage has been small, typically 2 to 5% of expiring contracts. But even small percentages applied to large open interest produce substantial delivery demands. If 5% of contracts expiring in a given month stand for delivery, and if open interest in that delivery month is 100 million ounces, the delivery demand is 5 million ounces. 5 million ounces against 32 million ounces of registered inventory is manageable, barely. But what if the percentage shifts? What if industrial users, concerned about supply security, decide to take delivery rather than roll contracts? What if investors, skeptical of paper claims, demand physical metal? What if the behavior that has kept the system in equilibrium changes even slightly? The arithmetic is unforgiving. At 23-to-1, a shift from 5% delivery to 15% delivery would demand more metal than exists in registered vaults. The exchange would face a choice: facilitate default or change the rules. Based on historical precedent, the exchange will change the rules. The forms that rule changes might take are predictable. The first form is margin increases. By raising margin requirements, the exchange forces participants to post more capital to maintain positions. Those who cannot post additional margin must liquidate. Liquidation reduces open interest and alleviates delivery pressure. Margin increases were the primary tool in 1980. They can be deployed rapidly, overnight if necessary. They are technically neutral, applying to all participants equally. But margin increases are not actually neutral. They disproportionately impact smaller participants who have less capital flexibility. Large institutions can absorb margin increases. Retail traders cannot. The effect is to concentrate positions in fewer hands and drive smaller participants out of the market. The second form is position limits. By restricting the number of contracts any single entity can hold, the exchange prevents concentrated positions from threatening the delivery mechanism. Position limits were also employed in 1980, retroactively applied to the Hunt brothers' positions. Position limits are presented as measures to ensure market integrity. In practice, they are measures to prevent anyone from successfully demanding delivery at scale. The third form is cash settlement incentives. The exchange can offer premiums to participants who agree to settle in cash rather than take delivery. By paying above the futures price for cash settlement, the exchange reduces physical delivery demand. This mechanism was employed during the 2020 logistics crisis, when COMEX offered substantial premiums for cash settlement of expiring contracts. Cash settlement incentives are an admission that the exchange cannot deliver the metal at the contracted price. They are a buyout, a payment to avoid default. The fourth form is forced cash settlement. If voluntary measures fail, the exchange can declare that delivery is not possible and settle all outstanding contracts in cash at a price determined by the exchange. Forced cash settlement has not occurred in modern COMEX history, but the exchange rules permit it under extraordinary circumstances. Forced cash settlement would end the fiction that COMEX futures represent deliverable silver. It would confirm that paper claims exceed physical availability. It would break the link between the futures price and the physical price. Each of these mechanisms, margin increases, position limits, cash settlement incentives, forced cash settlement, represents a step on a ladder of intervention. The exchange will climb the ladder as necessary to preserve its structure. But climbing the ladder confirms what the ladder is designed to hide, that the paper market and the physical market are not the same. The physical market is telling its own story. While COMEX registered inventory has collapsed to 32 million ounces, physical premiums have expanded. American Silver Eagles trade at $8 to $12 above spot price. Generic silver rounds trade at $4 to $6 above spot. Even 1,000-ounce industrial bars, the form deliverable against COMEX contracts, trade at premiums that did not exist 5 years ago. Premiums are the market's way of communicating that the spot price is not the real price. When you pay $50 for an ounce of silver that COMEX says is worth $30, you are voting with your dollars. You are saying that the paper price is fiction, and you are willing to pay reality prices. The persistence of these premiums, not as temporary spikes but as permanent features, indicates structural disconnection. In a functioning market, premiums attract arbitrage. Traders buy at the low paper price, take delivery, and sell at the high physical price, pocketing the difference. This arbitrage compresses premiums toward zero. But arbitrage requires that delivery be possible and practical. When registered inventory is 32 million ounces and declining, arbitrage becomes uncertain. Can you actually get the metal? How long will it take? Will the exchange change rules before you can complete the trade? The persistence of premiums indicates that arbitrage is no longer functioning to compress the spread. The paper price and physical price have begun to separate. Industrial demand adds pressure that the paper market cannot absorb. Silver is not merely a monetary metal, it is an industrial necessity. Solar panels require silver for electrical contacts. Each panel uses approximately 20 grams. Global solar installations are accelerating, projected to triple by 2030. Electric vehicles require silver for battery connections, electrical systems, and charging infrastructure. Each vehicle uses between 25 and 50 grams. Electronics of all types require silver for circuit boards, connectors, and contacts. Smartphones, computers, medical devices, military systems. Silver is embedded in the infrastructure of modern life. This industrial demand is price inelastic in the short term. A solar manufacturer cannot redesign panels overnight to use less silver. An electronics company cannot substitute copper for silver without degrading performance and reliability. Industrial users need the metal. They need it consistently. They need it regardless of price. When industrial demand meets constrained supply, industrial users do not wait for prices to normalize. They secure supply at whatever price is available. They take delivery rather than rely on paper contracts. They build inventory rather than depend on just-in-time delivery. This behavior, rational from each company's perspective, accelerates the drain on registered inventory. Each industrial user who takes delivery removes metal from the COMEX system. Each removal worsens the coverage ratio. Each worsening of the ratio increases anxiety among remaining participants. Each increase in anxiety drives more participants to take delivery. This is a feedback loop. It is the same feedback loop that drives bank runs, and it is currently operating in the silver market. There are beliefs about COMEX that deserve scrutiny. The first belief is that COMEX cannot fail because it is too important. This belief assumes that importance confers invulnerability. It does not. Exchanges have failed throughout history. Rules have been changed to prevent delivery. Markets have been suspended. The assumption that modern markets are immune to the failures that plagued historical markets is faith, not analysis. COMEX's importance makes its potential failure more consequential, not less likely. The second belief is that ETFs provide an alternative that makes COMEX delivery unnecessary. Silver ETFs hold physical metal in vaults. Investors can gain exposure without dealing with futures delivery. But ETF inventories have also declined. SLV, the largest silver ETF, has seen persistent outflows. The metal leaving SLV is not destroyed. It is transferred to other hands, often hands taking physical possession. ETFs do not solve the physical supply problem. They redistribute it. And ETF structures contain their own clauses permitting cash settlement under extraordinary circumstances. The paper claim on ETF silver is ultimately no more secure than the paper claim on COMEX silver. The third belief is that miners will increase production to meet demand. Silver mining is constrained by geology, permitting, capital investment, and time. New mines require 5 to 10 years from discovery to production. Existing mines operate at capacity determined by ore grades and extraction costs. Even at current elevated prices, silver production has not increased significantly. Production has remained approximately flat for a decade while demand has grown. Miners cannot solve a structural deficit by increasing production faster than the deficit is growing. The fourth belief is that high prices will destroy demand. This is partially true for investment demand. When prices rise, some investors sell rather than buy. But industrial demand is different. Industrial users cannot stop using silver without stopping production. They cannot substitute without years of redesign. They face a choice between paying higher prices or shutting down factories. High prices may eventually trigger substitution and demand destruction, but eventually is measured in years, not months. In the interim, industrial users continue to draw down available inventory. The question is not whether COMEX will fail in some dramatic televised collapse. The question is whether the current structure can persist. At 32 million ounces of registered inventory, the structure persists only through continued restraint by participants. It persists because most participants settle in cash. It persists because most participants trust that delivery is possible even if they don't request it. But trust is not static. Trust responds to observable conditions. When registered inventory falls month after month, trust erodes. When premiums for physical metal persist and expand, trust erodes. When industrial users take delivery rather than roll contracts, trust erodes. Each erosion of trust changes behavior. Each change of behavior accelerates the erosion. This is the dynamic that is currently unfolding. Not a dramatic failure, but a gradual loss of confidence that feeds on itself. Gold's relationship to silver in this context is instructive. COMEX gold inventories have also declined, though less dramatically than silver. The gold coverage ratio is tighter than historical norms, but not as extreme as silver's 23-1. But gold and silver move together during monetary stress. When confidence in paper systems erodes, both metals benefit. When physical demand accelerates in one metal, it typically accelerates in both. The silver inventory crisis may be the leading indicator. Silver's smaller market makes it more sensitive to shifts in physical demand. Silver's industrial use creates inelastic demand that does not exist for gold. If silver's COMEX structure breaks, if rules are changed, if cash settlement is forced, if the paper price and physical price fully decouple, gold will face similar pressures. The mechanisms are the same. The ratios are different but directionally similar. The participants overlap. Silver may be the canary. Gold may follow. This is not a prediction of imminent collapse. Markets persist longer than critics expect. Structures adapt. Participants adjust. The endpoint that seems inevitable may be delayed for years. This is an observation about trajectory. The trajectory is toward decreasing registered inventory, toward widening coverage ratios, toward expanding physical premiums, toward increasing delivery requests, toward rules changes that acknowledge what the market already knows. The trajectory has been consistent for 4 years. It has not reversed, it has accelerated. Trajectories do not determine timing, they determine direction. The direction is clear. Gold does not rise, confidence falls, silver does not spike, systems crack. 32 million ounces of registered silver is not a market statistic. It is a measure of how little physical reality remains beneath paper promises. 750 million ounces of open interest is not trading volume. It is a measure of how many promises have been made that cannot be simultaneously kept. 23-1 is not a ratio. It is the architecture of a system that requires faith to function. And faith, once it begins to erode, does not rebuild easily. The numbers tell a story. The story is not about silver prices. The story is about trust, in exchanges, in paper claims, in the systems that promised that promises would be kept. The trust is measured in registered inventory. And registered inventory is 32 million ounces, declining.